Let's just talk about stocks for a minute, shall we? Let's assume that your goal is to receive $200,000 a year passive income from your stock portfolio, and you don't want to spend down any capital that you put in, and you want to be taxed at a long-term cap gain rate. Here's how to do that. First, you buy some stocks, particular stocks that I'm going to tell you in a minute. Then you wait until the value of those stocks grow to a certain number that is essentially a tipping point, in which the growth is more than you can draw down. And then you start drawing and sell a little bit of those stocks every year forever. Here's an example. Let's say you put in 100,000. You pick the stocks whose annual growth rate is 24%. I'll talk more about that on the rest of these slides. And then you wait 12 years, it'll grow to 1.3 million. Then you start withdrawing. At 1.3 million and 24% average, you can draw down 23,000 a month forever, and you still have your 1.3 million. All right, let's poke at these numbers a little, shall we? First of all, just acknowledge that 24% is a lot higher than what you can get, what Vanguard will dare promise you. That's also a lot lower than our average annual gain of our portfolio. So let me dig into that a little. So specifically, NASDAQ, Vanguard, and Dow are all way down around 10 to 15%, whereas our average annual growth is around 40%, depending on how you calculate it. 40. So 24 is a lot less than our average. In fact, 24% is our worst year if you take a 10-year period. All right, so these numbers are way bigger, as I just showed you, from everybody else. Why? The main reason is that most stock funds like Vanguard, have to mitigate risk because the people that buy them are really worried about risk. They do that by a million warnings that you should wait, but they can't force you to wait. You can buy and sell at any time. So in order to further mitigate risk, they start buying stocks whose performance isn't as good, but that doesn't swing as wild during bad years. Even the aggressive growth funds in Vanguard have a lot of stocks that are meant to be stable. This is a mistake. Here's why. Okay, let's say that your Vanguard fund was just tracked NASDAQ, just all the tech stocks basically. So you can see that NASDAQ's performance on average is way below ours. And the main reason is because our good years are amazing. If you look at, for example, 2023, it's like 10 times NASDAQ's average good year. They've got a lot of just basic stocks that don't go anywhere, except when things go down. Then they go down with everything else. So our bad years are about the same as theirs, but our good years are way better. So our average is much higher. And like I said before, if you want to lower risk, you just have to wait longer. You shouldn't be trying to buy stocks that are diverse. You should just wait. Buy the aggressive stocks and wait to get your average risk down. This is the same information I showed you in that little chart, but it's a little easier to see here. The gray dotted lines are if you bought and sold any random one year. 2008, you would have lost half your money. If you bought 100,000 and sold it in 2008, you would have ended with 50. 2009, if you bought 100,000, you would have ended with 300,000. Sorry, 2. So, and yeah, 2020, even more. So every 1 year swings like crazy. Obviously, you shouldn't buy and sell within 1 year. 2 years, looking a little better. There's a couple years you would have lost money. There's a couple years you would have made no money, just gotten your money back. And on most years, you would have made a lot of money. But go to 5 years, and now you usually make money, somewhere between 25 and sometimes 50%. There were a couple 5-year periods where you wouldn't have quite made 25%. And over 10 years, you always would have made 25%. And a lot of years, you would have made close to 50. So I hope that shows you why the waiting is the key. All right, let's talk about what we own briefly. I'll just give you this list. You can recreate it from the slide. You can just see that it's a lot of tech stocks that go way the hell up when the market's hot, much higher than your average stock. So here's what's happened for us. Our Hilton fund, we got unlucky. We just bought right before the 2022 crash. And so our money went way down right after we bought. Fund 2, our E-Trade, we had done dollar cost averaging, which means we bought a little bit every month instead of all at once, and it performed much better. So this is over a bad period. We made 17% during a bad period, and our E-Trade fund, we made 36%. So over 2.9 years, we doubled our cash. Here's the hard part. Here's how it feels to put in 100K and see it go up and down. So this is over a 1, 2, 3, 4, 5-year period, and you can see that in 2022 we felt like, oh man, this is awesome. We got 400K, and then we lost 100K. Then we lost another 100K by the end of 2023, and it felt like the world was ending. Everybody's yelling about the stock market crashing and everything ruined. And then we just waited, and we ended up in a good position. This is what our actual individual brokerage did. And again, you compare that to NASDAQ. It went way up in 2022, whereas NASDAQ went up a little. And it went right down. You can see in the worst point, it was exactly where we started. And then we just waited a little longer, and it went way up again. So it's a 42% performance average annual performance over 3 years. And so really the key is being able to ignore the short-term movement. If you can put in 100K and ignore it for 5 years, you'll end with 400K. And that's a huge win. And if that risk still seems scary, you just have to be able to wait longer. So let's just go back to this goal. You want 200K a year, you want to keep your capital, you want to pay a low tax rate, you can do it. You're going to need to buy some stocks, wait till it goes up, and then sell a little bit. So for example, put in 100K, wait 12 years, and you're done. You can withdraw $23,000 a month indefinitely after that. Thanks for watching.